All right, so we're going to pick up this conversation and talk about capital losses now. Investments don't always go up. It'd be great if they did. We would love it, but they don't always go up. What happens when they go down? What happens on the tax side? Okay. Well, what happens is if you sell an asset, right, an investment asset for less than your cost basis, it's considered a capital loss. There's still short-term capital losses and long-term capital losses, right, depending on the holding period, less than a year, longer than a year. But these losses, right, a gain adds, you have to pay taxes on that, on the gain. On the loss, you actually get to deduct losses against your income. Okay, so let me walk you through how that works out. So number one, the capital gains and losses net out against each other of a similar type. So first you would look at short-term capital gains, short-term capital losses. This is all within one calendar year, like one tax year. Short-term capital gains, short-term capital losses. You net those out. Let's say you have 5,000 in capital gains, in short-term capital gains, and 4,000 in short-term capital losses. You net them out, and so you actually only had $1,000 in short-term capital gains. Okay, so you net those out. You do the same with long-term capital gains, long-term capital losses, and you net those out. Then you net out the gains and losses against each other. Okay, so you net those out, and then you have what's left. So in some cases, right, if you have a lot of long-term capital gains that you're realizing in a given year, you may actually intentionally sell assets that have lost money, right, that you want to get out of, right, if you want to like buy a different investment. And you can actually realize losses in order to offset the gains that you've realized, right? So if you're kind of doing an overhaul of your portfolio, you can sell assets that have a gain, sell assets that have a loss, try and offset those as much as possible to limit your tax liability as you're repositioning your portfolio. Okay, so it's really common. It's called tax loss harvesting, really common strategy in stock portfolios. Okay, so they net out against each other. Okay, if all said there's a total, then you take the total and that is your gain. If it's in the positive. Okay, if you net everything out and you have a gain, then it's taxed accordingly. If all said and done, you actually have a loss, you've lost money, you've lost more than you've gained, then you can deduct that against your income. So in any given calendar year, the max that you can deduct against your income is $3,000 if you file single or married filing jointly. So it's $3,000 that you can deduct against your other income. What if you have a loss that's greater than that? What if you have a $12,000 capital loss? Well, you can deduct up to $3,000, which is the limit, and then you can carry forward the losses, your capital losses, into future tax years and deduct up to the maximum in all those tax years. So you deduct $3,000 this year, and then you carry $9,000 forward to the next year, deduct another $3,000, carry it forward to the next year, deduct another $3,000, or you can have those offset against capital gains, right? Let's say this year you deduct $3,000, carry forward $9,000, but next year you have $10,000 of capital gains. Well, you net them out against each other, and then you have $1,000 gain. So I hope that makes sense. You can carry forward those losses. So it's important to track those over years if you were trying to carry forward losses to deduct against your current income. This same principle applies in real estate. As I've discussed, you can have a capital loss in real estate. If you buy a property and your cost basis is higher and then the value actually goes lower and you sell it, you can also have a capital loss there and carry forward losses. All right. Now, this is a very common situation that pops up, and I want to explain this to you. What about your own home? Is there capital gains tax due on your own personal residence? So we've had home values have exploded, right, over the last couple of years in many areas of the country. So all of a sudden, a home that cost $200,000 is now $300,000. So what happens if you sell it? Are there capital gains owed on that? Yes and no. Okay. So generally speaking, the answer would be yes. There are capital gains on your own home you have to pay capital gains tax on any gains in your own home. All right. But the IRS has an exclusion for personal homes, an exclusion from capital gains. So this is how that works out. You can exclude up to $250,000 of gain if you file as single, or $500,000 of a gain if you file married filing jointly. You can exclude that amount from your capital gains. And you just have to qualify using the ownership and the use tests. So, number one, you must have owned the property. And number two, you must have lived in it for at least 2 out of the last 5 years that you owned it. So you may have bought it and you lived in it for 2 years, and then you moved out maybe and rented it for a couple of years or something like that. As long as in the past 5 years you've owned it over that period and you've lived in it personally for 2 years, and then you sell it, then you qualify for this exclusion. You can get this amount of gains excluded, either 250 or 500,000 excluded. So let me just kind of walk through a quick example to kind of illustrate this. So in my previous example, let's say that you bought a home, it's $200,000. That's your cost basis. And by the way, the mortgage, right? If you got a mortgage on a property, that all nets out against itself, okay? So if you don't buy a property all in cash, right? You might put down a down payment and then have a mortgage for the rest. Your principal payments go into the cost basis and increase the cost basis, right? Your equity. And sometimes other expenses can add to the cost basis. If you've done like renovations and remodels, like you put in $20,000 into remodel the kitchen, that can actually go in to add to the cost basis. Okay, so maybe you put in 20,000, that adds the cost basis, but increase the value by 30,000, that is a gain. Okay, so you kind of have to track that if this is something you're looking to do and don't qualify for the exclusion. Okay, if you qualify for the exclusion, it makes it a lot easier. But anyway, the mortgage, when you sell, the mortgage nets out against the sale price, and it really is just how much you put into it originally and how much you ended up getting out of it. So we're not talking about the mortgage in this example, but let's say you got in, your cost basis is $200,000, and when you sold, you ended up getting $300,000. Okay, so there's a $100,000 capital gain. If you owned it for anytime in the last 5 years, if you owned it and lived in it for 2 of those years, then it is excluded, right? The $100,000 of gain, you are not taxed. Okay, it's an exclusion. If you don't qualify, let's say you lived in it for 2 years and then you moved out and rented it for 5 years, they would look back and say, okay, well, you owned it for 5 years, but you actually didn't live in it for 2 of those years during the preceding 5 years. So that $100,000 is a gain, and you're going to be taxed on it by long-term capital gain rates. Okay. Then the flip side, let's say your cost basis in a property was $500,000. And then when you sell it, because properties have gone up dramatically, let's say when you sell it, it's worth $1.25 million. And you're married filing jointly, and you meet the ownership and use tests, right? You lived in it for 2 of the last 2 years of the last 5, and you've owned it for that time period, and you sell it. Well, then you have a $750,000 gain, right? $500,000 cost basis, $1,250,000 fair market value, sale price. Okay, so $750,000 gain. You can exclude $500,000 of that from tax. So $750,000 gain minus the $500,000. So you have a $250,000 capital gain left, okay, that you're taxed on, long-term capital gain. All right. So hope that makes sense. There are a lot of people that ask me all the time how to get around this. There's really not a whole lot of ways to get around this, okay? There are some ways to get around gains, and we'll talk about those, but not with this exclusion. They're pretty particular about this, okay? Now, this doesn't have to be your only, like your primary home. It could be a second home, right? Like you could own a home, live in it for 2 years, and then move to a new home and rent that one out. So it's not your current home. You can sell it and get that exclusion. But there are some restrictions. You might not be able to qualify for the exclusion again on your current home until a certain time period and things like that. So if you have questions about that, obviously talk with a tax professional on that. But that's how the capital losses work. So we'll move on to the next topic. See you guys soon.
Knowledge of capital losses helps you plan with confidence.